One of the attractions to working in real estate is the ability to be your own boss as an independent contractor. But being an independent contractor also means that you have to properly manage your income. I'm Heather Elias, Director of Social Business Practice at the National Association of Realtors. To get ideas on how to better manage the sometimes irregular nature of your commission income, I'm here with Victoria Gillespie, National Director of Business Development for Realtors Federal Credit Union, a division of Northwest Federal Credit Union. Victoria's most recently come from being a sales associate at RE/MAX Realty Plus in Mount Airy, Maryland, but she also has over 20 years of experience in financial management, banking, and investments. Thank you for being with us today.
Thanks for having me, Heather.
Why don't we get started with the topic that plagues most realtors from the get-go, taxes.
It's a great question. Many realtors or any self-employed person will come to the end of the year and be surprised at the aggregate of what they actually made throughout the year. So what I suggest first off, I am not a tax advisor, so we sort of need to disclose that clearly. However, selecting a CPA that's on your team, that's in your community and knows your business model is very important. So nothing can be a substitute for good tax advice. But based on experience, if you could take each transaction where the income flow comes in and allocate a portion and say this will go towards my year-end taxes, you will eliminate any surprises with an enormous tax bill at the end of the year. As a rule of thumb, I would probably say because tax brackets vary across income levels, I would suggest a 30% rule of thumb allocated in a liquid savings to prepare you for your year-end taxes.
So it's my understanding you have some pretty terrific tips on how realtors can maximize their deductions on their taxes. Would you mind sharing those with us?
Well, it's a topic near and dear to everyone. One of my favorite, I think, for realtors, many times the realtor is not working out of a corporate office, out of a franchise office, because you typically lease that space. So what they do is they use a remote home office. But many times they forget to create the tax deduction and get the benefit of that home office. So what I suggest is figure out, ballpark, how many square feet you're using to operate your business each day, and then take that percentage and apply it to your living expenses so that your utilities, if it's a mortgage, whatever the cost may be, you allocate the percentage proportionate to what your office space takes up. So that's a big one. Number two, realtors track mileage and gas and fuel, and that becomes labor intensive. So one of the big ones that realtors use now are automated tracking. Two of the big ones in the industry now are MileBug and Speed Tracker, and you enter in your starting point, city and mileage, and then you close out at the end of your destination. But it helps have a place for stops and incremental visits to other businesses and gasoline and fuel, and it's all in one consolidated report that you can prepare at tax season. So that's a great one. As a credit union and a prior banker, record keeping is near and dear to me. I mean, it's not a fun topic, but probably the number one reason people don't benefit from deductions is because they don't keep adequate records. So what I suggest is in your mind, and you say, should I keep this, should I not? I would say to myself, if I were audited tomorrow, what would I need to document my path? And very straightforward. So clean records, very important. And that goes into my fourth one, is as a realtor, we lose track of, is it me as a realtor, is it my business entity, have I set up a business entity? What you want to remember is business expenses should be kept separate from personal expenses. You really shouldn't commingle because you can never determine if your business is profitable. You never know if you have net income. So I suggest a separate operating checking account for the business and then your personal, and then don't commingle the expenses. Keep clean records with business coming out of your business checking, personal coming out of your personal checking. The final two, and they're actually fairly large, but individual retirement accounts create tax-deferred savings. So if realtors are proactive in putting away for their retirement years, they can then take advantage of those deductions in the current year. So retirement planning is critical, and because they likely don't have a 401k or company-sponsored plan, being self-employed, this should be real high up on their priority list. The final one is many times people won't want to pay a tax advisor. And just like you pay your doctor, you pay your attorney, I'm a firm believer, you pay your CPA. That is actually one of my favorite checks to write because they can help me minimize my taxable income. So to me, I get a return on that every time. So I would suggest that they be committed to paying a tax advisor, know that's part of the business model, and to feel comfortable that that's a necessity to operate a business.